Here's the real bombshell. How IonQ paid for these deals. Did they spend cash? No. Because they don't have much. IonQ is unprofitable and does not generate meaningful cash from operations. Instead, they financed these acquisitions mostly by issuing stock. Oxford Ionics was $10 million in cash, $1.6 billion in stock. Capella Space, $48.3 million in cash, $376.5 million in stock. ID Quantique, $116.2 million entirely in stock. LightSync, $100,000 in cash, $36.7 million in stock. Kabech, $22.1 million cash, no stock. Step back and look at the picture. IonQ only spent $80.4 million in actual cash. The remaining $2.4 billion was paid in stock. This is the real point investors need to understand. IonQ financed acquisitions by issuing new stock at high valuations. Each deal dilutes existing shareholders, like slicing a pizza into smaller pieces. Even if the pizza grows, your slice gets thinner. When a company repeatedly uses stock as currency, it signals something important. They expect investors to keep paying inflated prices to raise capital. If the stock price falls, the strategy collapses. Further dilution could be on the way. If IonQ continues acquiring companies without profitable operations, positive cash flow, or meaningful organic revenue growth, issuing more stock becomes the only path forward, putting investors at risk of becoming bag holders. Is IonQ doomed? No. Quantum computing is one of the most promising industries of the next decade. IonQ has strong technology, a clear roadmap, and a head start in a competitive field. Acquisitions can accelerate innovation. But smart doesn't mean safe. The issue isn't the tech, it's the business fundamentals. Right now, IonQ is spending billions, generating tens of millions, diluting shareholders, relying on stock instead of cash, and taking on multiple companies that will take years to integrate. For a speculative company, that's risky. For an investor, extremely risky. What Ion needs now is execution, not more acquisitions. Execution means turning new technologies into products, generating revenue that grows faster than dilution, getting closer to profitability, and demonstrating clear ROI from each acquisition. Until then, caution isn't just smart, it's necessary. IonQ is exciting, innovative, and ahead of the curve. But it's also diluting shareholders, spending far more than it earns, relying on valuation-fueled acquisitions, and asking investors to trust a long-term vision without short-term proof. The $2.5 billion warning is simple. Growth is meaningless if shareholder value gets diluted out of existence. If IonQ wants long-term investor confidence, it must prove acquisitions were worth it. Revenue must grow significantly, dilution must slow, and integration must succeed. Until then, investors need to stay sharp, cautious, and informed. Quantum computing is one of the most exciting and confusing sectors out there. The mission is to help you make sense of it one step at a time. If you found value in this breakdown, share this with someone who follows tech stocks. Let me know in the comments. Do you think IonQ $2.5 billion spree is genius or reckless? Thank you for watching. Quantum computing investors, this is your wake-up call. Because while everyone is busy celebrating IonQ's soaring stock price and dramatic acquisition spree, there's a $2.5 billion warning sitting right under the surface, and most investors are completely missing it. Why is a company generating only $80 million in revenue over the last year suddenly spending $2.5 billion on acquisitions? Why is IonQ issuing enormous amounts of stock instead of paying with cash? And the biggest question no one seems to be asking, are investors being set up for massive dilution? and maybe even disappointment. Let's dive deep into the deals, the numbers, the strategy, and the hidden risks that quantum computing investors need to understand before jumping on the hype train. Full transparency, this is analysis and commentary. The information shared in this video is for educational and informational purposes only. All data and insights discussed here were sourced from publicly available information, including the company's official websites, press releases, and investor reports, as well as reliable sources. Not a buy recommendation. Always do your own research before making investment decisions. When a young tech company goes on a shopping spree, headlines get exciting. Investors think, wow, they're expanding fast. They must be building something huge. IonQ has been doing exactly that. For a full year, IonQ has acquired a string of companies: Oxford Ionics, Capella Space, ID Quantique, LightSync, an undisclosed marketing intelligence platform, and Kabech acquired in December 2024. In total, IonQ has spent $2.5 billion in the last 12 months. Mergers and acquisitions aren't new. Companies buy competitors, complementary technology, or customer bases. It's part of growth. But here is what most investors are not asking. Is IonQ actually generating enough revenue from these deals to justify the cost? Or are these deals simply expensive bets? IonQ is a pure-play quantum computing company, meaning quantum is their entire business. Their roadmap depends on scaling hardware, expanding capabilities, and absorbing unique IP before competitors grab it. On the surface, the acquisitions sound like they make sense. Oxford Ionics brings cutting-edge trapped ion technology. Capella Space adds imaging and sensing capabilities. ID Quantique gives them quantum encryption expertise. LightSync likely provides specialized quantum hardware or capabilities. Kabech brings valuable IP and talent. When you say it fast, it sounds smart. But when you look at the numbers, a different picture emerges. You'd expect big acquisitions to generate big revenue. Let's break down what IonQ actually got from all these acquisitions. Oxford Ionics was acquired in September 2025, basically at the end of the third quarter, so there wasn't enough time for meaningful contribution yet. Capella Space, acquired in July 2025, added $9.6 million in revenue. ID Quantique, acquired in April 2025, added about $9 million. So between Capella Space and ID Quantique, roughly $18.6 million in total contributions so far. LightSync and Kabech did not report any revenue at all. In total, IonQ's revenue for the last year is $80 million. $80 million in annual revenue versus $2.5 billion in acquisition spending, with several deals contributing little or no revenue. Oxford Ionics had just closed, so almost zero contribution expected. LightSync revenue is undisclosed, usually meaning small. Kabech was labeled immaterial in the CONPANY's 10Q. IonQ spent $2.5 billion for revenue contributions that barely move the needle. Acquisitions take time to integrate. But investors should ask, how long can ION afford to wait? And at what cost?